If you have a pension, you're going to face a choice that most people get exactly one shot at. And over the course of 20 or 30 years in retirement, that decision can be worth more than $100,000. The question is, do you take the monthly check for life or do you take the lump sum? If you pick wrong, there's no going back. This is one of the few decisions in retirement that you cannot undo. But those two options, the monthly check and the lump sum, are not your only choices. There's a third path that hardly ever gets mentioned that can pay you thousands of dollars per year more for the very same amount of money. I recently walked a client through this exact decision, so I'm going to use his real numbers to help you make the right choice for yourself. My client is 70 years old, and his pension provided him with the classic choice. He could take the lump sum worth about $1.1 million, or he could turn on a monthly payment of $7,338 for life with a 100% survivor benefit, which means if he passes first, his wife keeps that exact same check for the rest of her life. So, which option is better? Each side has a real advantage and a real cost. The monthly payment is guaranteed income for life. You can't outlive it. So, it takes the whole question of running out of money off the table. The cost is that it's inflexible. Once it's on, it's on. And with a traditional company pension, depending on the survivor option you pick, the payments can simply stop when the second spouse passes, leaving nothing behind for your kids or anyone else. The way I explain this permanence to clients is a bathtub. Turning on the pension is like pulling the drain. The water flows out to you as income and it never runs dry. But the moment you pull it, you can't put it back down and scoop a bucket of water out when you need one instead. The income flows, but the pool of money itself is no longer accessible. So, this creates a question about liquidity. If your pension is the bulk of your retirement savings and you turn on payments, you've locked yourself into a fixed monthly check for life with no way to reach the principal ever again. And that sounds fine right up until life does what life does. A lot of people dread the thought of living on fixed income. And if that's you, especially if the pension is most of what you've saved, keeping some liquidity can be reason enough on its own not to guarantee every last dollar. The lump sum is the complete opposite. You roll the funds into an IRA with no tax when you do it, and now you're in control. You can invest it, you can take what you need, and whatever left goes to your heirs. The cost is the investment risk now becomes your burden. You have to prepare for a rough market, a long life, or simply overspending because that guaranteed floor is gone. Many times, this decision comes down to what you value more, certainty or control. Financially speaking, there's a quick rule of thumb you may have heard of that gives you a starting point, and it's called the 6% rule. You take the monthly pension payout and you multiply it by 12 to get the yearly amount. And then you divide that number by the total value of the lump sum. If the answer is 6% or higher, the guaranteed monthly income is usually a strong deal. If it comes in below 6, you can often do as well or better taking the lump sum and investing it yourself. Let's try this out with my client example. His monthly pension was $7,338. So times 12 is about $88,000 per year. Divide that by his $1.1 million lump sum, and you land right about 8%. That's well above 6%. So for him, the guaranteed income side of this was very attractive right out of the gate. The reason this rule was created is pretty simple. If you pulled 5% per year out of that lump sum and earned nothing at all, it would still take you roughly 20 years to run through the whole thing. And in the real world, your money would be invested in earning something, so it would likely stretch even longer than that. So, for a monthly pension to be worth locking in over the lump sum, it needs to pay you north of 5%, and 6% is that rough line in the sand. His 8% cleared that comfortably. But that rule is a starting point, not the answer, and every credible source that teaches it says the same thing. It can't see the things that really decide this for you and your family. It ignores whether your pension has a cost of living adjustment. It ignores taxes. It ignores your health and how long you're likely to live. It ignores how financially solid the company backing that pension is. And it completely ignores what you could do with the lump sum if you invested it instead. So use the 6% rule to get your bearings, and then let go of the idea that any single number makes this decision for you. Now, the part that almost nobody ever talks about is if you decide you want the guaranteed income, don't just flip on the company's pension like it's your only choice. You need to make sure that it is the highest payment possible. What I mean by that is you can take the lump sum and buy your own income annuity from a highly rated insurance company, single life or joint life, exactly like the pension. And very often, but not always, a highly rated carrier will pay you more for the same money. Again, let's go back to my client. His company pension offered $7,338 per month with that full survivor benefit. When we shopped that same $1.1 million to a highly rated carrier for a joint income annuity, the quote came back at $7,957 per month. Same guarantee, same survivor protection for his wife, but $619 more every single month. That's about $7,400 more per year for the rest of both of their lives out of the identical amount of money simply because we made his pension compete instead of accepting the first offer on the table. That being said, a lot of the time, your company pension will pay just as well or better. And if that is the case, you stay right where you are with no harm done. But the only way to know for certain is to run the numbers and compare. Worst case, you confirm the pension was the better deal and you turn it on with total confidence. Best case is you find an extra several $1,000s per year sitting on the table. Either way, you win, which is exactly why you never skip the due diligence. There are a couple things you need to factor into this comparison, though. Some pensions raise your check a little each year to keep pace with inflation, and some don't. If you're a government or federal worker, there's a good chance yours does, and that's a real point in the pension's favor. But if you're in the private sector, like my client was, automatic raises are rare. His pension was a flat check for life, which is exactly why the annuity that pays more from day one was the better deal. Just make sure you're comparing the same thing, either a raising pension against a raising annuity or a flat one against a flat one. The second is the strength of the company behind the annuity. A pension has a federal backstop, so if you decide to purchase an income annuity instead, you must only buy from a carrier rated very high by AM Best. Don't get tempted by a lower rated company just because it quotes you a bigger number, because the whole point of guaranteed income is the guarantee. Highly rated insurance companies have the strength to pay that income for the rest of your life. And even in the worst case, these obligations don't just vanish. Another company steps in and takes over the payments. And it's worth understanding that insurance companies aren't regulated like banks. A bank only has to keep a small fraction of its deposits on hand. A life insurance company is required by law to hold reserves built specifically to cover the future income it's promised to pay, backed by conservative assets and watched by state regulators. That's a big part of why these guaranteed income streams have held up through every major downturn. And there's a built in advantage to going this route that answers the single biggest fear most people have about giving up the lump sum too. Unlike a traditional pension, this version keeps an account value that can still pass to your kids or heirs if there is anything left, not the insurance company. There's a fee for that guarantee, usually around 1% per year, but it comes out of the leftover value, not your income, so it never lowers the payment itself. On my client's 1.1 million, if they had only received $900,000 of payments before they passed, the other 200,000 still goes to their kids, which traditional pensions typically can't do. But I'm not telling you to buy one of these, and I'm not telling you to avoid it. The two most dangerous words in all of finance are always and never. Because the moment someone uses them, that isn't advice anymore. That's called an agenda. Choosing between the lump sum and a monthly pension is part math and part psychology. Because how do you calculate peace of mind? Every rule of thumb treats this like a pure numbers problem, as if the only goal is squeezing out the highest possible return. But money that lands in your account every month, like clockwork, no matter what the economy looks like that day, provides a tremendous amount of security for many people. Knowing the mortgage and the groceries are covered for the rest of their lives is worth more than a slightly bigger number on paper for many people. So if someone tells you that a lump sum wins by some small margin, you need to ask yourself what certainty is worth to you because it's real, even when a formula can't really put a price on it. But if you decide that guaranteed income is what you want, Whether you get it from your company pension or from an annuity you shop for really is pure math. It comes down to one question: which one pays you more? That being said, this doesn't have to be all or nothing. You don't have to take the lump sum and invest all of it in the market, or take all of it and buy monthly payments. Say you work out that you need $5,000 per month guaranteed to cover your true essentials, your mortgage, your utilities, the things that have to be paid no matter what. You can use part of that lump sum to buy exactly that much guaranteed income and invest the rest for growth, for access when you want it. Now you've built your own custom pension, part guaranteed floor and part flexibility, that is growing and designed for your actual life. And whatever you land on, don't breeze past the survivor decision, because it's the piece that hurts couples the most. When you turn on a pension or an annuity, you choose how much your spouse keeps if you go first, usually around 50, 75, or 100%. Taking a bigger monthly check with a smaller survivor benefit can look great on paper, right up until the moment that you pass away and your spouse watches that income get cut at the exact moment they're alone and most vulnerable. My client chose the full 100% survivor benefit on purpose, so his wife's income never changes no matter what happens to him. That protection is often the entire reason to lean toward guaranteed income in the first place. But here's what I would like you to take away from all of this: the real decision boils down to two questions. First, how much of your income do you want guaranteed? Do you want enough to cover all of your essentials, or more than that for real peace of mind, or none of it because you'd rather keep it all invested in liquid? There's no universal right answer. Second, for whatever amount you do want guaranteed, whose guaranteed income is the best deal? Your company's pension or a private annuity that you shopped for? Then, whatever's left, if anything, stays invested and accessible. Some people guarantee all of it, some guarantee none of it. Most people do land somewhere in between. So let me know what you plan to do with your pension. Do you think monthly payments or taking a lump sum works better for your retirement? Leave your comments below. I'd love to hear them. And for those of you new to the channel, I post videos every single week. If you found anything interesting about this video, please give it a like. And please consider subscribing, or if you know someone who might find this interesting, please consider sharing the video. And if you ever like a hand applying any of this to your own situation, you'll find a link right below in the description whenever you're ready to schedule time to speak with us at no cost to get your retirement questions answered. Just remember, the difference between worrying about retirement and enjoying it usually isn't about having more money. It's about taking the time to inspect what you already have and building a plan around it. As always, I appreciate you spending part of your day with me, and I'll see you in the next video.